UnitedHealth stock reported quarterly financial results that gave investors a little bit more confidence in the company's ability to turn things around. Of course, I'm happy about that. I rated UnitedHealth stock as a buy ever since the stock price crashed earlier this year. Thankfully, it's up from its lows and it continues to improve. In this video, I'll review the company's latest quarterly financial results, share with you my updated fair value calculation, and update my buy, hold, or sell rating on UnitedHealth stock. Let's jump right in. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So the company reported consolidated revenues of $113.2 billion for the quarter, representing and pointing to the evidence of just how large of a business this is. Revenues were up 12% year over year, and revenue growth has not been the problem for UnitedHealth. The problem has been costs that are increasing well above what management was anticipating for the current fiscal year. That's why earnings from operations came in at just $4.3 billion, which represented a net profit margin of 2.1%. And I want to highlight something interesting, not just about UnitedHealth right here, but just about how management teams disclose financial information to investors. As you'll notice, for the revenue figure, they give you the year-over-year growth number, right? They say it increased 12% year over year. But for the earnings from operations number, they just tell you it's $4.3 billion. They're not telling you whether or not this increased or decreased year over year. Now, I want to test your ability to analyze management thinking here and tell me what you think the year-over-year number was for earnings from operations. Do you think earnings from operations increased or decreased year over year? Now, if you say they decreased, then your instincts are in the right place because management teams will often withhold information that doesn't show the company in a good light until later on in these press releases and financial statements. They'll bury them like on page 38 of a 42-page report. So this is just something to take note of when you're evaluating management teams. Management is very great at presenting information in the way they want investors to see the information. So it's important to dig through these details and understand what management tries to get you to think and really take a look at the numbers and evaluate the results yourself without taking too much account into what management teams say, unless specific management teams have earned your respect, have earned your ability to trust them by years and years of reporting excellent results and forecasting things and then delivering on those things that they forecast. So they've got to earn your trust. You shouldn't just automatically take the word of what a CEO or CFO of a company says just because they are a CEO or a CFO. Doesn't mean they automatically earn our trust. So they discussed their third quarter medical care ratio of 89.9%, which reflected utilization in line with expectations outlined in Q2 25. The year-over-year increase of 470 basis points was primarily driven by the previously described elevated cost trends, as well as the ongoing effects of the Biden-era Medicare funding reductions and changes to the Part D program from the Inflation Reduction Act. So this is why UnitedHealth stock price crashed earlier this year when management disclosed that the costs for delivering on the services they agreed to deliver this year for their customers was well above what they forecasted. And since they did not have the liberty to change their prices in the middle of the year, they just had to absorb these higher costs and experience lower profit margins as a result. There wasn't hardly anything they could do about it this year. Now, they will adjust for that next year and increase their prices next year to reflect these higher cost trends. But until then, their profits and profit margins will be depressed. Cash flow from operations came in at $5.9 billion for Q3 25, which was 2.3 times their net income. So this is important to consider that even though the company is going through all these difficulties and struggles, stock price extremely volatile, more so than is usually the case for a relatively safe company like UnitedHealth, they're still generating billions of dollars in cash flow. They're still generating billions of dollars in profits. And so overall, it's still a healthy company, pardon the pun there. Overall, it's still a good company in delivering these kinds of performance metrics. It's not in any kind of trouble of losing cash or any kind of increased difficulties in that sense. What's under question here is the company's ability to grow their profits and grow their cash flow as connected to what management and investors were expecting from the company over the long term. So here is the company's consolidated statement of operations, or in other words, their income statement. And this is for the 3-month period that ended September 30th and the 9-month period that ended September 30th. And you get a comparison from this year and last year. So let's take a look at how cost increased and the biggest driver of its cost increase. So you could see total revenues increased from 100 million to 113 million. So billion. Revenue increased by 13 billion. Well, you look at the operating cost, the biggest increase here is medical cost, which jumped from 65.9 billion to 79.9 billion. Or in other words, it jumped by 14 billion. So operating costs increased by more than the total revenue increased, which is not an attractive to be in, not an attractive position to be in. When you're a company, especially the size of UnitedHealth, this is not a fast-growing startup where you're investing aggressively for growth opportunities, in which case I would understand your cost increasing by more than your revenues. This is a stable, mature company at large scale, and they're benefiting from economies in scale, and typically their revenues are increasing quicker than their costs are increasing. So overall, total operating costs jumped by more than 16 billion, and therefore you see their earnings from operations fell by more than half, from 8.7 billion to 4.3 billion, right? And remember above when we were looking at the page 1 of this press release where they told you that earnings from operations were 4.3 billion, and I quizzed you on whether or not you thought this was higher or lower from the same point last year. And now you see the answer to that question. It's way lower than where it was last year. And so you can understand management conveniently omitting that information, as management teams will do, to try and influence your thinking about a business and its prospects, right? This isn't the only management team that does this. I'm just highlighting this because it was an obvious situation where immediately when I saw that, my eye is trained for this. After evaluating thousands of these kinds of press releases, I knew exactly what was going on here. And you can see that their operating income fell by more than half. Earnings from operation fell by more than half. Okay, so all that being said, do I still think this stock is a buy? Remember, I've had it rated as a buy for several months now. So let's look at my updated fair value calculation for UnitedHealth. So what you're looking at is my proprietary discounted cash flow valuation model, which values a business and gives me a fair value that I think is a reasonable price to pay. And that price I calculated at $458 for UnitedHealth, and the current share price is $358. So it's still meaningfully undervalued according to my calculations. So I will update my rating for UnitedHealth. As I noted earlier, I've had it rated as a buy, and today I updated and reiterated that buy recommendation for UnitedHealth Group. They're going through struggles in adapting to their miscalculation on the cost side, but they have the ability to increase prices in the upcoming fiscal year, which they will certainly do. They've already told investors they will do that, and they're okay if they lose some customers as a result of their price increases. They want to maintain their profit margins and the business usual growth in earnings per share and cash flow. And so they're okay with losing a few customers if that's what it takes. And so I expect this business will gradually return to regular profit margins over these next, the management team said it's not going to immediately return to their typical profit margins, but over the next couple of years, it will progressively return to their profit margins and earnings per share growth that they're typically used to for this company. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.